Hello everyone, and welcome to your Glassnode video update for week 34, 2022. Now today what we're looking at, after we've broken back down below the realized price, we're actually going to explore the mechanisms that really signal that the weakness was there. And we actually talked about this back in week 31 when we started to get this momentum, but we just simply didn't have the on-chain activity follow through. So we're going to expand on this concept and really explore what the weakness was that was underlying this particular rally. So some things to actually pay attention for if we do get a recovery, but also things to pay attention to during these bear market rallies to see whether we actually do have weakness or if there's some kind of follow through really supporting the move. So again, the reality of price and the way that on-chain and all the fundamental behaviors interact is obviously a complex one. So what we're looking for here is we did see a rally up from that 20,000 level to about 24.5. Now, what we've seen is we've since broken back down below 21,700, which is where the realized price is, which actually puts the average Bitcoin investor, based on the price when they last moved their coins, back underwater. So we're going to explore that fundamentally from the on-chain activity front. We're going to look at how we actually dissect retail investors and speculators. And we're also going to look at the macro spending profitability, which kind of signals a bit more time to recover. And we're going to set up some of these different concepts and ideas to be paying attention to for when we really do start to get a recovery across all of these metrics. That generally signals that we may be heading for greener pastures. So as usual, please do give us a rate, a share, and a subscribe. It really does help get the more people watching this channel. Please, as always, let me know in the comments what you enjoy, what you're learning from these sessions, what else you want to see. I'm more than happy to produce content that kind of fits in with what you want to learn about. So we try and package this up into different concepts and ideas, so you start to learn piece by piece how we can use on-chain to really understand what's going on. So let's get started. So here we are in our week 34 dashboard. We're looking at a bear market Mirage, and this is again trying to pick up this difference between when you have a bear market rally and it actually looks like it will fail and doesn't have the follow through, versus when the start of a bull market comes, which generally signals that there is more fundamentals behind it. But again, we actually don't know whether it's a bear market rally or the start of a bull market, or potentially both, until long after the fact, because you have to look back in time and say, well, that actually was the bottom. These things are very, very hard to tell in advance. So what we're looking for here is what actually happened, what were the realities of those fundamental factors that really led to this weakness, and does it signal that there's more weakness on the horizon? So the first thing we're going to start with is our valuation models. Now, the first model we have here in yellow is the realized price. So this is the average price at which every single coin in the supply last moved. The way to think about this is kind of like a cost basis. What is the average acquisition price for every coin in the supply? Now you can see that towards late stage bear markets, we typically interact with it. It's almost a bit of a zone. It's not the precise bottom, but it picks up somewhere around a zone of influence where we are underneath that cost basis. A lot of the market is underwater, and we are approaching that high level of pain, that seller exhaustion phase. But as you can see here back in 2018, this took a period of time. This is about 140 days. On average, we spent about 180 days below the realized price. And here we only had 36. So we did have a short excursion of about 23 days above it, but we have since pulled back below it. So what we're really seeing here is that we kind of revisiting and just putting in that time duration. We haven't yet fully fleshed out this bottom yet, and we'll discuss some of the mechanisms later on. Now, you can also see that closer to the bottom of the previous bear market, we have the balance price in blue, and in purple, we have the delta price. So the balance price is a bit of a coin time weighted average. What it's looking at is not just the volume of BTC that's moving, but we're also bringing in how old those coins were. So we're really picking up a bit of a time weighted moving average of that transfer. And then in the delta price, that's a bit of a hybrid model down here at the very bottom. We've actually never seen a daily close below the delta price. So it's currently trading down here at 13,760, which I'm sure most people watching probably don't want us to close down there. And also there can be a first time for everything, but these are really giving us some different models to kind of capture the different potential levels if we do get continued weakness down the road. So bringing it back at about 17,180, we have the balance price. This is factoring in coin volume and how old those coins were. So we're really trying to pick up where that kind of long-term cost basis is. Where do people who have older coins believe that that cost basis should be? And then we also have the delta price, which is that hybrid technical and on-chain model, which again, on a probabilistic standpoint, has never been broken below on a closing basis. So some kind of targets in case we do really get some downside to give you a bit of a view on where we may actually see support coming in. Now, bring it back to the current rally and some mechanisms as to why it failed, why we didn't get that kind of continued momentum breaking up above 25,000. So we can see here, this is the accumulation trend score broken up into different wallet cohorts. So on the top here, we have greater than 10,000 wallets, then we have 1,000 to 10,000, all the way down to 1 to 10 and less than 1 BTC. So down the bottom, we're really talking about retail investors, small scale investors, less than 1 BTC. On the top, we're talking about kind of mega whales, right? 10,000 BTC plus. Now, the blue zones indicate, and you can see here in this phase A, the blue zone indicates high degrees of accumulation. Their balance is growing significantly. So during this phase A, notice how the retail and the shrimp, retail, shrimp, and whales were accumulating heavily. Now, this immediately followed that sell-off down to 20K. So there's about a month-long period of very, very strong accumulation. The rest of the bands were a little bit meh. There wasn't much going on, very, very neutral. Their balance wasn't really changing much. We actually explored this in a previous session. Now, what we're looking at in phase B, note the very distinct color change. Retail really softened out. Whales softened out and then actually went into distribution mode. And the rest of these cohorts went from neutral to distribution as we got some kind of price momentum. As we broke up above the realized price specifically, we started seeing a behavior shift. So you can see that generally speaking, we've got a bit of upwards momentum, but a lot of cohorts took that opportunity to actually distribute and take some profits out of the market. So this is typical of bear market formation, the very, very bottom. It takes time. Markets are a process, not a result. So it does take time, and you can see quite clearly here that we did have distribution following that rally. So that kind of sets the tone for moving forward. So this is actually a really interesting metric. This is a workbench creation and one that is really, really powerful, but also very simple. So as we mentioned in the previous week on-chain editions, we didn't see that on-chain activity follow through. On-chain activity really defines how many people are using the network. Are there more transactions? Are people more urgently getting transactions into blocks? Are they paying higher fees? Think about it like the user base. Is the user base growing or shrinking? So the chart that we have plotted out here is called New Address Momentum. This is a workbench chart. And again, if you ever want to see how these workbench charts are constructed, you can click on this little magnifying glass. It will expand it into a new window, and you can actually see how the formulas come together. And we'll talk about more of that later on. So in the blue curve, we have the 1 year moving average of new addresses. These are new addresses coming into the network. So we can think about this kind of like the baseline, the C baseline. In the red curve, we have a slightly faster 1 month, 30-day moving average. So what we can see here is that during the blow off top, following 2017, and then also back here in 2021, notice how the 30-day dives significantly, well and truly below the 1 year moving average. Same over here. This is really signaling bearish momentum. We are seeing fewer users relative to the 1 year average. It's kind of a reduction in momentum. Fewer users, probably not so great for network effects. Now, during the bear market, note that this typically trades sideways, but generally also underneath the 1 year average. It's in that bearish territory. It's recovering, but it's kind of flat, right? Overall, it's kind of the same users, that hodler base that we talk about on a regular basis. But note when we got this break above at the bottom, right down here after this major flush out, we had an expansion, more addresses, there's more people using the network. We had this excitement starting to grow. Now, 2019 was one of these funny years where it kind of had the rally and then we actually returned back into a bear market. But note how the bear market is characterized by sideways activity. March 2020 happens and then bang, an explosion of new activity, new addresses grow much, much bigger than the 1 year average. This is a constructive sign. So we kind of had the initial wave, we moved back into sideways consolidation, and then bang, we had our bull market kick right in. So we've had a very similar pattern in our 2020-2022 cycle. We've had the initial flush out. We had the recovery back to all-time high, which note didn't get above the 1 year average. So we kind of actually found resistance here, and we've been trading sideways. So notice that during this rally, we really didn't have an uptick. So this is a particular metric that I would be paying attention to. You should be able to see this if you are on an advanced plan. You can actually use Workbench to track this model. What we're looking for is that explosion of near term, that 30-day moving average, to really pick up some steam. And that would give some confidence that we do have a return of new users. The user base is expanding relative to the 1-year average. So that would be a good sign and something to be paying attention to as we move forward. Now, in a very, very similar manner, we have our percent revenue from fees. Now, as you would expect, if you've got more people transacting on the network, there's going to be more congestion. And thus, in order to get your transaction confirmed, you have to pay a slightly higher fee. So fees are a fantastic model. You can see how they also collapse following the bull market top. They collapse following our bull market top, and they essentially stagnate for the majority of the bear. 2019, again, was this push higher, but it was short-lived. And then you can see how the the bull markets really, really stand out. So at the moment, we are on this baseline. We've had, following the lunar collapse particularly, we've kind of reached a new plateau. So it's not as bad as it was, but it's also not exactly ripping higher that we've seen in the past. So it's kind of an early sign, but we still have a bit of work to do. We really want to get this metric up above about 2.5%. And again, I talk about this all the time, confluence matters. If we get an uptick in our address activity and we have an uptick in fees, you're starting to build a much stronger picture. You're looking for multiple metrics to really tell you that something is going on over time. So you can use these to really build up conviction and confidence when you have multiple things signaling the exact same way. So now we're going to transition and look a little bit at transaction volume. And we're going to explore this from a few different layers. We're going to start with this one here. Now, you'll notice for a number of models as we come in, we're using a big picture 90-day moving average, right? A quarterly moving average. The reason we're doing that is because we're looking for macro confirmation. Obviously, when you have metrics that move around a lot, there's a lot of daily noise. And if you're using like a 7-day, that will smooth out that daily noise, but it can still be on a big picture. If we're looking for when this market really is starting to recover, a 90-day is going to be slower. It won't be the first thing to react, but it will give us a higher level of conviction when it does happen. So it's giving us the big picture. In this instance, that's kind of what we're trying to assess. We're looking at the bigger picture here. So when we look at the total transfer volume, this is the amount of US dollar denominated value moving through the system. Notice how, again, after that bull market peak, this is why I say that on-chain activity, transaction volume, transaction counts, active addresses, fees, they're such a powerful system to just spot the overall momentum. Are we in a bull or a bear? Often we can explain that purely by looking at on-chain activity. Note the massive just decline. This thing just decays all the way through the bear. It's 2019, we get a little bit of an uptick, not really much, and then the bull market stands out like a sore thumb. Now you can see that since that peak here in May, we've seen a macro decline. This is all transaction activity. You can see here down in the dark blues, what we're looking at here is entity adjusted volume. These dark blues are 10 million and the greens are $1 million plus. These are very, very large institutional size transactions. So whilst overall, notice how this general chart is declining. Note how the dark blue is actually trading sideways. The dark green is trading sideways. And really that means that the decay is happening in these smaller bands. The smaller bands are retail. So institutions still maintain a very, very large dominance. And in fact, their dominance has grown in the transaction space. So it kind of shows that evolution of Bitcoin as an asset. But now let's just quickly jump across and look at retail in a higher degree of resolution. So here we've isolated only transactions that are less than $10,000. Again, that's trying to just band around and see where are our retail investors. And what you can see is that we have seen a massive decline, right? It's essentially come back to early or late 2020 levels. So we've seen a significant decline in overall retail interest. And again, this is just another piece of evidence in our full scope for we have low activity on addresses, we have low transaction fees, and the amount of volume moving around the system is kind of indicative that retail aren't that interested right now. So we are seeing this kind of cohesion between all these metrics telling us a very similar story. And as we saw before, institutions are actually growing their dominance, but that's because the smaller guys are actually shrinking the amount that they're transacting. So we haven't hit that escape velocity yet. See here how we have these explosions higher following March 2020 and even 2019. We want to really see this macro scale start to pick up because that signifies that we're getting more interest, more hype, more excitement. Again, you can see here it doesn't pick the bottom, but we're looking for that change in market structure, that change in character on a big picture, which gives us more confidence that maybe there's some substance behind that rally. So in a very similar manner, and actually including a lot of those retail investors, we're also going to look at speculators, people moving money in and out of exchanges. So the chart that we have here is the same. It's looking at transaction volume, but only coins that are flowing into exchanges in red and out of exchanges in green. You can see a very, very similar pattern, actually. So you can see that overall, I mean, exchanges account for about 40% of all blocks-based consumption. So it makes sense that a huge amount of the transaction volume is going to be in and out of exchanges. You can also see that we have both huge inflows and huge outflows every single day. This is 2 billion. This level here is about $2 billion. So we're actually trading somewhere around 1.75 billion on a daily basis of in and out total combined. But you can also see that generally speaking, we have seen a macro decline. We are also back here to late 2020 levels. So we really have kind of decayed a lot of that speculative interest as well. And much the same as our previous metrics, the massive drop off following the bull market top. And then we have a period of consolidation, and really a significant uptick of these levels is a good sign. So overall, again, we have a very, very cohesive picture. We don't really have retail. We don't really have speculators. There's just not a lot going on. It's pretty quiet. So when we see a rally from 20,000 up to 25, it's not seeing any follow through. So at the moment, we just have to keep those bear market goggles on until we start to get this macro recovery of a lot of these metrics. Now, in a very similar model to what we looked at above with our active addresses, we're looking at the short-term versus the long-term moving average. We're doing the same here, but with exchange flows. And again, it's another one of this is a workbench model that we can use. We're looking at inflow plus outflow, the average of those two. So basically, what is the average flow coming in and out of exchanges? And then we're looking at, is the last month, the last 30 days, higher or lower than the long-term 1-year average? So very, very similarly, we get these big collapses. You can see how so many of these metrics tell the same story. It gives you confidence, both on volume and addresses. And you can really use this to have a very confident picture that we don't really, see how we don't have an uptick here? It's kind of a bit weak. We don't really have that uptick yet. But you can see that when a bull market kicks in, we do see that activity. Price goes up. People get excited, people start speculating, coins start flowing in and out of exchanges. You get these reflexive loops where the market actually tells you what's going on because we're seeing people coming in for the hype, the excitement. They see it on the news. They've got a friend that's getting rich. All of these things kind of play into the human behavior patterns that we see play out on chain. So with the exception of the sell-off after Luna, and then again, as we sold down below the 20,000 all-time high, these two events had a slight uptick, but note how we're actually lower than we were before that. So overall, the amount of exchange flows are pretty insignificant relative to their long-term average. So thus, we don't have that speculator either. So we don't have retail, we don't have speculators, we don't have on-chain activity. There's a lot of things signaling that maybe this bear market just needs a bit more time to kind of put in that final floor until we finally get people coming back in. So the last topic we're going to talk about is bringing those concepts back to what would a healthy recovery look like? So obviously we need to have demand flow back in, right? Because everything is supply and demand. And over time, there's two types of pain really in financial markets. There's prices falling, which is, I think we all understand why that's painful, but there's also boredom. When these things chop sideways for very long periods of time, which really, if you look at the 2018 bear market, it's just a very, very long sideways chop, albeit volatile, but that boredom flushes out those final sellers. And really the end of a bear market happens when there are no more sellers, because then there's literally only buyers. Now, of course, there's always going to be sellers, but that's the general concept of how these markets over time turn around and you see this bear transform into a bull and vice versa. So on a very macro scale, what we're looking at here is the net realized profit and loss. So look at all the coins that moved on a particular day, and look at the price when they were acquired on chain to when they're being spent. And then calculate, did they move in profit? Did someone last acquire their coin at 10,000, is now spending it at 22? Or did they acquire it at 52 and are now selling it at 20? Because that would be a profit or a loss respectively. So again, we have a 90-day moving average applied here. And what we're really looking for, note how the bear market back in 2018, it was all red, right? This is predominantly losses. Now, remember, this is a 90-day moving average, very, very big picture. Note how it missed the first part of the 2019 bull. So, and you can see here it actually missed from the March 2020 crash all the way up to about 12,000. So the 90 days miss a large portion of these moves. And they're also, no, in the bull, at the end of the bull, they're very slow to react. However, once they actually flip over, because they're a long-term average, they typically hold for a long portion of that rally or that bear market. So where we are at the moment, we've had a significant period. Look at the scale of this. It's at the same level of relative losses that we saw back here in 2018. So in terms of the amount of damage done, it's kind of similar. This took a lot longer to play out. So again, there's that duration element that we may not have done our time yet. We may need a bit more time to just reaccumulate and form that bear market low. But the scale of the damage is roughly approximate. And you can see it's starting to curl around and head back north. Now it's not there yet. So we still have some time to actually go through this recovery. But you can see that this uptrend, as we return back towards a neutral level, it's showing that people are realizing fewer losses. Now, what does that mean? That means that there's fewer people with coins that they bought at the top selling. So that means that we've exhausted the sellers. Now, there's another thing that means. That means that there's more profits in the system. As price rallies, people take profits. And if price keeps going up, someone had to be buying those profits. So we're seeing an influx of demand to actually absorb sell side. Now, people get excited about markets when they can make money. This is just a hard reality of how these things work. So if no one can make money, naturally we would expect our interest in the asset to go down. This is the reflexivity to the downside. This is why bear markets take a long time. But once we start moving higher and demand starts coming in and people start making profits, they start telling their friends, and these things slowly start to turn around. So what I'm looking at here is when this metric really starts to move into a strong uptrend, and once it breaks above neutral, that's typically a good sign alongside all of the metrics we saw above. We want to see that reversal back to the upside. We want to see profits improving, active addresses ticking higher. All of these things tell us a cohesive story that we might be recovering. And they're also telling us a story that we're not quite there yet. So it kind of gives a bit of background as to why we actually saw weakness in this rally. Now, the very last one we're going to look at is the same concept that we just talked about, profit and loss, but from the short-term holder perspective. Now, remember, these are coins that last moved less than 155 days ago. Statistically speaking, coins that are younger than 5 months are the most likely to be spent. They fill out the majority of transactions, and those that are older than 5 months are more likely to stay put. They're the hodler cohort. So what I want to really describe here, again, here's that massive collapse in profitability. People are essentially like, oh man, I bought the top. I need to get my money back. As SOPR returns back to a value of near 1, this means that the amount of coins that are being spent are basically just getting their money back. They're selling at cost basis. So you can see this return, resistance, resistance, and then we have our final flush out. Here we are during our bull market in 2020 and 2021. We have our initial washout. We actually broke above. I mean, we hit all-time high, so it kind of makes sense. There was a little bit of profit taking, but note that the amount of profits being taken was much, much lower than it was up here, and yet we still couldn't push through. This is a big bearish divergence. We came back just above break even. Short-term holders go, just get me my money back, right? Their money back was buying the top here. They sold this top. Yeah. So what we're basically seeing is that this big bearish divergence, we got above 1, but they really did. They were still selling to get their money back, and we've since descended into that second wave. So again, there's a lot of similarities between this current bear market and the very late stage of 2018. There's a lot of things that look very similar. The thing that's really remaining so far is we haven't had the recovery yet, and we haven't really done the time. We've been down here for 36 days under the realized price, or 37 as of today, rather than the 180 days that we typically spend down there. Now, again, none of this means that we have to be down here for 180 days. We may be down here for 2 years. We could also be down here for 2 months. But over time, what we're really looking for is what are the signals that are really going to give us confidence that we're getting a return of demand, a return of retail, a return of speculators, and a return to profitability. And all of these things, if you have a really cohesive picture and they're all telling the same thing, starts to give you a bit of confidence that we may actually be starting to return to a more sustainable recovery. So thanks everyone for tuning in. Hopefully that explains a bit about why we had this weakness. Why did this rally fail? Why did we sell off down from 24,000 to 21,000? Such a short red candle. And hopefully it really explains that there's a lot of factors to it. And what we're looking at is all these different things that are telling a cohesive story. So hopefully you enjoyed that. Do be sure to check out this new address momentum. This is our metric of the week. And again, this is a workbench chart, which you can access from the dashboard. It will be available for anybody with an advanced account. So you will be able to actually unpick it. If you have any questions on how we develop these, we are producing more content for our advanced members in Glassnode forum. We're calling these market pulses. And what we're trying to do is really capture some of the ideas that we're looking at in the background and particularly focus on workbenches, how we built them, why we built them, what are the formulas that we use, and really opening up the discussion to help you all understand how to use these tools better. So until the next one, I'll catch you then. Cheers.